Hello and welcome to AJ Bell's Spring Tour webinar. My name is Marcus Paraduke and I'm the Business Development Manager for the South East North region, and I will be your host this morning. This tour, as you may have well already noticed, has a slight tangent to our typical roadshow content, and today we'll be bringing a firm focus on the fundamentals of investing. To cover all bases, we've recruited some special guests to make sure you get the full picture. We'll be joined by experts from Vanguard, BlackRock and Langley Consultants. As always, you can ask questions throughout the session via the chat function. Our team will ensure the questions reach the relevant speaker and we'll come back to you as quickly as we can. You can also put any questions or comments on the feedback page that will pop up immediately after the webinar finishes. And if there are any topics you'd like us to cover in the future, please let us know. We will be continuing to run online content once a month, and your suggestions help to ensure we're providing content you find useful. A quick reminder on your Cpd certificates. These are emailed together with a copy of the slides post-event. Please note that we have hundreds of advisors joining us online for our webinars, so it takes us a little bit of time to collate the data and generate the items you need. But rest assured, we will get your post-event items over to you by email as soon as we can. So please ensure you have a drink to hand, sit back, relax, and enjoy the variety of talks we have in store for you today. Our first speaker this morning is our very own Managing Director of AJ Bell Investments, Kevin Durant. Those of you who have heard Kevin present before will know you're in for a treat. Never want to shy away from an opinion and passionate about his topics of discussion. Today, he's going to discuss building a CIP. He'll look at the asset classes available to investors and we'll make a few proposals on how you could think about future risks, returns and asset allocation. Following on from that, he'll then take a look at how risk profiling tools work and how they help to match suitable portfolios. Kevin, it's over to you.
Okay, thanks for that, Marcus. Nice introduction there. Let's get stuck in today with the first presentation, which is called Great Expectations. What we're going to do is take a look at all capital market assumptions and then see how they integrate with the various risk profiling tools that are out there. And at the end, we're really trying to assess the different types of portfolios. What can you and what can your clients expect in today's capital markets? Okay, so without further ado, let's remind ourselves why we're here in the first place. AJ Bell exists to help people invest. And that's what you do. That's what you do with your customers. You have these wonderful people. There's around 4 million people in the UK who take financial advice. So that's around 1 in 14 adults in the UK investing with you as a financial advisor. But these wonderful people are really just here to invest their spare capital. Over their entire lives, they've earned more income than they've ever spent. And as a consequence, they have excess savings, which they're looking to put to work in the markets. Now, on the other side of the world, we have capital markets. And what you have here is equally fantastic people, but these are people with ideas. They're ideas which push society on, which make us make progress as a species. They have these ideas, but they don't have the capital to turn those ideas into reality. So these companies, which are invariably set up as, are seeking capital. And our job as an industry is to bring those people together. Now, the stuff in the box there, that's largely commoditized. That's AJ Bell and other platforms in the marketplace, multi-asset managers and single strategy managers. And essentially, as I say, that's largely commoditized. What you're trying to get access to is this kind of stuff. And this is, your basic level kind of assets and asset allocation that you will use in your portfolios to make your customers' dreams and wishes come true. So all the way down there, you can see I've kind of already started to organize this in some sort of risk spectrum. So all the way down there at the bottom, you've got various cash and cash deposits, going through bonds, shares. And as you go up that ladder, that risk ladder, what you're doing is you're introducing more uncertainty, more risk, and potentially even higher returns. Now, wouldn't it be nice if a portfolio was as simple as that? All you had to do was pick a bond fund, maybe a couple of shares, and possibly a little bit of property in your portfolio, and all of your needs were taken care of. But of course, investment gets a little bit more complicated than that. And you can go down a whole bunch of rabbit holes and split those asset categories into ever more delineated groups. So in cash alone, you've got foreign currencies, term deposits, domestic deposits. We get into shares, and you can split this. I've only split this 4 different ways. We can split it in a whole myriad of different ways, whether that be international versus domestic stocks, growth versus value, sectors versus geographical exposure. The list is endless, large and small cap, etc. Now, what you've got on here is a whole range of different assets which will have different expected returns, different expected risks, and when they come together, they will interact in various different ways. Now, I'm going to assume for the purposes of today that everyone who's listening to this has done some elements of portfolio theory. You'll all have investment management certificates or RO2 or wherever the appropriate qualification is, but you're all familiar with Markovit's portfolio theory. And you know that you need expected returns, expected risk, and expected correlations of assets in order to project forward what your expected risk and return of your portfolio will be, and hence, as a result, make some predictions about how your portfolio will perform into the future. Now, I've mentioned a couple of words there which are really, really important, and the cartoon on the screen identifies how we think about this at AJ Bell. There is no such thing as a free lunch. Risk and return are inextricably linked. If you want higher returns, you have to accept you will be taking higher risk. If you are taking higher risk, you ought to be compensated for that risk in the form of higher returns. There's no such thing as a free lunch, and that fundamental belief really drives a lot of how we look at portfolios and how we look at asset classes. Now, whilst there's no free lunch available in the marketplace, what there is lots and lots and lots of free information in the marketplace. And that's how we look at markets at AJ Bell. When we take a look at markets, what we're looking at here is not just the price of things, but what we're really looking at is the collective wisdom of all investors that are invested in all of the markets across the world. That's an awful lot of free information. And we can use that collective wisdom to find out what markets are currently forecasting about various asset classes and what those expected returns will be way into the future. Now, that free lunch principle in more formal terms is also known as the no arbitrage principle. And we'll be using that no arbitrage principle as we go through the rest of the presentation. So as I've just said, if you look at current marketplaces, what that shows you is current expectations for future returns on different asset classes. What you've got in this case is certainty. Now, you don't get certainty on lots of investments. Now, if I go into the cash markets and I want to put my money on deposit for a couple of days, I will receive the short level rate of return, which is currently around 0.5%. But we don't invest for days and weeks. We invest over a multiple year period. And in fact, what we'd say is that you ought to be investing for at least one cycle and preferably 2 or more investment cycles. Now, a typical investment cycle, it's slightly over 5 years, but for the purposes of today, we'll round that to 5 years. And let's look throughout all of our expectations, let's look at expected returns on various asset classes over the next 10 years. Now, as I said before, what you've got here is absolute certainty. If you buy a UK government bond with a 10-year maturity, right now, as we're presenting this presentation, right now in the marketplace, that gives you a yield of 1.4% annualized. So you're guaranteed over the 10 years of holding that bond to receive a 15% total return. And that 15% is guaranteed. The only way you don't get that 15% is if the UK government decides to default on its debt. Now, don't get me wrong, some governments do default on their debts, but typically governments which are well established and also have control over their own currencies, they don't default on their debts because, of course, they can revert to the printing presses in order to print the money in order to repay those debts off. And indeed, over the last 10 years, the UK government and lots of major developing governments have resorted to printing presses, both for the financial crisis and also more recently in the COVID era. So we know those printing presses exist, and we know that governments are not scared to use them. But as a consequence of that, printing money invariably leads to higher inflation, and indeed we're starting to see that in developed markets right now. So this 1.4% annualized return, 15% over 10 years, whilst it's a guaranteed nominal rate of return, it's not a guaranteed real rate of return. So there is indeed actually some uncertainty, that uncertainty due to inflation, in a 10-year nominal government bond. And so what we should be doing is looking not at nominal bonds, but 10-year index-linked bonds. Now, it's an unfortunate circumstance, but since November 2011, every single index-linked bond in the United Kingdom now stands on a negative yield. And currently, as we sit here today, the negative yield on a 10-year index-linked government bond in the UK is -3%, which means over the next 10 years, that will deliver a -35% real return. Now, lots of people misunderstand index-linked government bonds. They assume that inflation is going to be higher, therefore I should be buying index-linked bonds. The returns on index-linked bonds are not driven by inflation, and I'll explain what I mean by that in a moment. The primary return on index-linked bonds is driven by the real yield on that bond, and in the UK right now on the 10-year bond, that's a -3% annualized return, or -35% in real terms. So why do people obsess about inflation when they're looking at index-linked bonds? They're obsessing about inflation because what you're actually doing when you buy an index-linked bond is you're making a judgment not about what the real rate of return will be, but what the break-even level of inflation will be. So we've said here, if I buy that 10-year nominal bond, I get a 15% nominal return over the next 10 years. And if I buy the indexing bond, I get a -35% real return over the next 10 years. What that tells us is, over the next 10 years, the market expects inflation over that 10-year time period to eke out 50%, or around 4.4% annualized. That's what you're doing when you're making an assessment between indexing bonds and nominal government bonds. And because millions of investors are making that determination on a daily and minute-by-minute basis, what we can back out of that is the break-even inflation rate. And so the market is now telling us that real returns on government bonds will be -3% annualized, nominal bonds will be 1.4% annualized, and inflation over that 10-year time period will be 4.4%. Now, I'm going to put aside for the moment whether you think it's going to be higher or lower than 4.4%. All I want to establish here is, when we're looking at these bonds, the market is telling us collectively, using its collective wisdom, what real returns will be, what nominal returns will be, and what inflation rates will be over that 10-year time period. And so you've now got a framework where we can take a look at any nation, any currency, use the government bond marketplace within that country, and we can determine real returns in that currency, nominal returns in that currency, and inflation in that currency or that country. Which brings us to an even greater insight. Now, here we are, we're 10 minutes into this presentation. I put a horrible looking equation up. I'm going to quickly explain, and it doesn't really matter the details of this equation, but I'm going to quickly explain what this equation is. What you're looking at on the left-hand side is I, and that's what interest rates ought to be in any currency. The R with a little star next to it is the natural real rate. The pi is not the pi that you remember from school, which is diameter versus circumference of a circle. It's the inflation target. The stuff in the brackets is where inflation is currently versus the inflation target. And the bit on the end, there is something that economists refer to as the output gap. Now, as I say, we're 10 minutes in, and I don't want to scare anyone off with a horrible equation. This equation was written in 1993 by John B. Taylor. And John B. Taylor is eponymous with this equation. It's known as the Taylor rule. You remember, in 1993, only a couple of nations in the world were using inflation targets as a means of inflation setting. And so what John Taylor did in 1993 is said, if you are using inflation targets, here's a formula that you ought to be using in order to ensure that you hit your inflation target and you also hit that inflation target with no output gap. And what is the output gap? The output gap looks at where GDP currently is and assesses where GDP ought to be. Now, GDP, where it ought to be, sounds a little bit nebulous, but it's actually a really easy concept. The GDP is a function of two things and two things only. And they are how many people are in your economy and how productive are those people in the economy. So GDP growth is a function of population growth and productivity gains. Now, if you're setting interest rates correctly over the course of a complete cycle, remember we've talked about at least 2 cycles, you would expect the output gap to be 0. You would expect inflation to be on target. And so the last 2 terms in that equation actually cancel each other, actually disappear. And you're left with a very simple equation, which is interest rates over the complete cycle ought to be a function of the natural real rate of growth, which is actually your real GDP. And then you add on top of that your inflation target. Now let's apply that to the UK. In the UK, we have population growth just under 1. And typically we get better at doing things at a rate of about just over 1% per year. So in the UK, you could legitimately expect real GDP growth to be around 2%. Our inflation target is just over 2%. And so you'd expect interest rates in the UK to average over a cycle around 4%. So not only do we have information in the marketplace of what rates of return are available to us, both in real and nominal terms, what the bond markets also tell us are expectations of what you can expect from the economy looking forward. And actually, if we look at the real yield curve, as I mentioned before, real yields are negative and have been since 2011. For the past 11 years, the bond market has been predicting a 30 to 50 year depression within the UK economy. There's something ain't quite right there. Either you believe that we go into a 30-year depression or there's something wrong with bond markets. That's something we'll return to a bit later on. So we've now got a framework for real yields, nominal yields, inflation expectations. We know as a consequence of that what market expectations are for economic growth, and as a consequence of that also productivity gains and population growth. So lots of free information just by looking at UK government bond markets. What we're now going to do is see, okay, well, let's introduce a bit more uncertainty into the situation and look at what happens when we go from government bonds into corporate bonds. So what I'm going to introduce is a fictitious bond. Both of these bonds don't exist. I've invented them so that the numbers are round and the numbers come out, and they're conceptually something everyone can wrap their head around. So we've got a UK government bond, 10-year government bond on a 1.5% yield, which will give you a 16% return over the 10 years. Or we've got a Tesco 2% yielding bond, which will give you a 22% return if the default risk was also 0. But as we said before, UK government has access to a printing press. Tesco whilst it might feel like they have the license to print money, they don't have access to a printing press. And so the default risk on Tesco is unlikely to be 0. And therefore, over all possibilities of that Tesco bond, you won't get a 22% total return. That is the return you will get if Tesco do not default, but we have to incorporate all of the various possibilities. And for that, we can go to physics. Some of you may be familiar with quantum uncertainty that goes in quantum physics. So we're going to introduce Schrödinger's cat here, and we're going to look at a whole range of different possibilities for the Tesco bond. And I'm going to give you a scenario where Tesco absolutely does default. It defaults in a year's time, so you've had your 2% coupon over the first year. It defaults, Tesco goes into administration. The administrators that are appointed, they sell off all of Tesco's assets and they pay off all of Tesco's creditors, you being one of them as a bondholder. And as a consequence of that process, you lose 20% of your initial capital, but you did get a 2% coupon, so your total return has been minus 18%. So we've got two states of the world now. We've got a state of the world where Tesco doesn't default and you make a 22% gain. And we've got a state of the world which we'll call Tesco oh no, when it does default and you make an 18% loss. Now, we talked about something before, the no free lunch principle or the no arbitrage principle. For no arbitrage to be available, the return on the Tesco bond ought to be expected, because it's a 10-year bond, has to be expected at around 16%, which is the rate of return you get on the government bond. So we can look at all the different possibilities between the Tesco world where it does default and the Tesco world where it doesn't default. And what we find is with a 15% probability of default, you've now re-established the no arbitrage principle and you've got a 16% gain. So again, in the price of this Tesco bonds and comparing it to the rate of return on government bonds, the information buried in that in those prices, we can now calculate what's the probability that Tesco will default on its loans. And in this case, using these fictitious numbers that I've put into there, we've got a default rate of 15%. Now, Tesco is a BBB investment grade corporate borrower. But of course, we know that there are other standards available for corporate bonds. So let's now apply this not to investment grade corporate bonds. Let's now apply it to high yield bonds. So we're going up that risk ladder yet another point. And I'm going to introduce you to this Cineworld bond, which again doesn't exist, but it's a 4% coupon bond, again with a 10-year maturity. Now, in this instance, what we're looking at is if that bond were not to default, you'd make a 48% return. And as I'll demonstrate in a moment, let's suppose it falls over straight away and you lose half of your money. You have a world where Cineworld defaults and you lose 50%. You have a world where Cineworld doesn't default and you make a 48% return. We do exactly the same cat experiment that we did before. And what we can derive from that is the default risk in this case is not just 15%, it's been bumped up to 35%. There's a 1 in 3 chance that Cineworld defaults. And if it does default, you'll lose more capital. Now, the question you should be asking now is, okay, well, I understand that there's a bigger risk of default with Cineworld, which is a CCC rated corporate borrower, but why would I lose more money? Now, for that, you go to balance sheets. So what I've got here, these are actual balance sheets of both Tesco and Cineworld from their last reported company reporting accounts. And I've just taken a snippet of the balance sheets here. So in Tesco's case, you've got assets of 45 billion, total liabilities of just under 33 billion, and equity of just over 12 billion. Now, in that liabilities, Tesco has 6.2 billion pounds worth of debt. Let's look at Cineworld. You've got total assets of 10.6 billion, practically no equity whatsoever, just 200 million pounds worth of equity on the balance sheet, and 4.7 billion pounds worth of debt. And so if the value of the assets are written down, which they invariably are in an administration process, you can see that in the case of Tesco, Tesco's assets would need to be written down by more than a third in order to wipe out all of the equity. Whereas in Cineworld's case, the value of the assets only need to be written down by a couple of percent, and you've wiped out all of the equity. And that's what happens in an administration process. Equity represents the first loss when it comes to winding a company up. So they're the first, they receive all of the kind of major gains when the company does exceptionally well. But the quid pro quo for that is, in the event of distress, equity shareholders are the first people to take the loss. And it's akin to exactly what happens in a World War I trench. So you'll all be familiar with the Blackadder Goes Forth episode, and you all remember how that unfortunately ends. Now, somewhere in the background, Stephen Fry has a whistle in his mouth, and he's about to call his men all over the top. That's what happens in an administration process. Equity represents the foot soldiers. They are the first people over the top, first people storming the barricades, and the first people to get mown down. So if we go back to our balance sheets, what you're seeing is Tesco has a reasonably well fortified balance sheet, whereas Cineworld have really down to their last troops. And that's why in times of distress, that's why you will see bigger losses on companies with less less equity on their balance sheet in relation to their total liabilities. And that's why they're high yield, they're more likely to default, and more importantly, you're more likely to lose capital in the event of default. So if we think about that from a balance sheet perspective, and let's go back to our World War I trenches, if there's practically no equity on the company's balance sheet, and you are a creditor of that company in the form of its corporate bonds, if there's no equity left, you're the next person over the top of the trench, and therefore you represent the first loss if the assets are written down. Now you start applying that philosophical kind of thought to high yield, you would expect as a result of that, well, I'm facing the same risk as an equity investor, therefore back to my fundamental belief that risk and return are inextricably linked, what you should expect is the returns on high yield bonds ought to be commensurate with the returns that you would see on equities. And indeed, if we look at the last 10 years, that has pretty much been the case. Now, the last 10 years are actually slightly unusual when you look at this relationship between high yield and equity. You can see there's a strong correlation, which is exactly what you would expect. But actually, the returns on equities versus high yield bonds is actually higher than you would typically see over any 10-year window as a consequence of the 10 years that went before. So from 2002 to 2012, high yield bonds actually outperformed equities over that window. And so all you're seeing in this 10-year window here is equities playing a bit of catch up. Typically, in a 10-year basis, the rate of return that you get on high yield bonds, you can add around 1% onto that, and that will give you your expected return when it comes to equities. And that expected 1% additional return is really a function of the optionality that comes with equities. So if we think back to our World War I trenches, lots of the people will go over the top, lots of those soldiers will be mown down, but there are some equity foot soldiers who don't just kind of go over the top and survive, they go on to get military crosses and Victoria crosses. They're the heroes of the situation. They perform heroic acts. And in equities case, you get to benefit from those heroic acts. You get to benefit from the Apples of this world who, capitalize on long-term trends and generate exceptional returns over real long-term time periods. So that optionality that comes with equities typically manifests itself now in a rate of return on equities, which is about 1.5% higher than you'd expect to get on high yield bonds. So we've gone from index-linked bonds, nominal bonds, investment grade corporate bonds, high yield corporate bonds, and now we've created the footbridge between high yield corporate bonds and equity returns. So if I know what my expected returns on high yield bonds are, I now can just tiptoe over that bridge and also calculate my return or expected returns on equity. So we've gone really high up this we've gone really high up this investment ladder using market observable information in order to derive expected returns on all of those bonds, all of those corporate bonds, all of those high yield bonds, and all of those equities. And we can do that in multiple currencies and multiple locations. We've pretty much solved at this stage all of the capital markets. But we can look at equities a different way. What I want you to play a game with me here. Spot the difference between index-linked government bonds and equities. And if anyone is playing along, there are a couple of differences in these two pictures. So see if you can spot them as well. But take that thought experiment of what's the difference between an index-linked government bond and equities, and that might feel so far away in terms of levels of risk. But now if you look at this from a cash flow perspective, what we're looking at here is the FTSE 100 dividend payments over the past 10 years and the next 3 years in terms of expectations. And if I now look at early on in 2010, that was a dividend payments from FTSE 100 companies of around £45 billion. Let's now rebase RPI. So it starts at £45 billion and goes up in line with inflation subsequently. Now you'll see there, even in 2020, So as a consequence of the pandemic, and governments told a lot of organizations, including banks, for example, that they were not allowed to pay dividends, and lots of commodity companies fell into distress and decided not to pay dividends as well. Even after all of that, over the 10-year period between 2010 and 2020, the cash flows you receive from equities are not dissimilar to the cash flows you would have received if you'd invested in a large government-backed index-linked bond, where the cash flow and the coupons you receive would have grown in line with inflation. But if we project this forward another couple of years, based on current market expectations, you can see that over that entire 13-year period, dividends will have grown by around 5% per annum, whereas inflation will have grown by 3.1% per annum. And that difference between the two is about what you would expect, because you would expect the dividends from companies in an economy where inflation is growing, you would expect all of those companies who are intermingled in that economy, you would expect them to be putting their prices up, and as a consequence growing their profits. Of course, their costs will grow as well, but their profit margins can be maintained, and as a consequence of that, they can pay out their dividends. You would expect dividend growth to be in line with not real GDP growth, but actually nominal GDP growth. And that's why you've got that roughly 2% difference between inflation and dividends over that time period. It represents the real growth in that economy, which is why we talked earlier on about where does real growth in an economy come from? It's productivity gains and it's population growth. So you can see how now we've kind of rounded out the entire argument and linked all of these asset classes together. Which brings us back to our kind of final bit in this before we delve a little deeper, which is your equity risk premium is a function of what's called the real yield gap and your expected real growth in dividends. Now, your real yield gap is observable. So currently, let's use the FTSE 100 again. FTSE 100 is currently on a dividend yield of 4%. The 10-year index-linked bond we showed earlier is on a real yield of -3%. So there's a 7% gap between the dividend yield on FTSE and the real yield on index-linked bonds. And you've got expected real growth in dividends, let's say it's 1.5 to 2%. That would tell you that your equity risk premium, so how much you're being paid for taking equity risk versus bond risk right now, is probably to the tune of around 9%. And that's about as high as it's ever been. That tells you, if you're now applying this to a tactical asset allocation framework, that would tell you that your big question of whether I should be in bonds or equities, the equity risk premium tells you kind of how much you'll be compensated for not being in bonds and instead being in equities. And right now it's about as high as it's ever been. So equities versus bonds feels like a pretty simple decision to be making. And if anyone was playing the spot the difference, that's where those spot the differences were. So we've gone through all of these asset classes now, from government bonds, investment grade, high yield corporate bonds, equities. We can apply this a little bit now to alternatives. Now, if we look at property typically, if you think of rental flows, etc., again follows a distribution not dissimilar to equities. So you can apply all the methodologies that we've looked at in equities to property. But when we come to alternatives, that's when things tend to fall over. And the reason they fall over is you'll notice throughout all of this, I've used cash flows in order to determine the valuation and the valuation metrics on all of the asset classes. Now, a lot of alternatives don't have any cash flow. And as a consequence, under our definition, if you don't generate any cash flow, and you never will generate any cash flow, that's not an investment. It's a speculative asset class. That's not to say you might not want them in your portfolio for diversification purposes, but we have to be very clear here, they're not investments. And commodities is a great example of this. Commodities generate no cash flow. They never will generate any cash flow. If you're holding commodities in your portfolio, it's with the intent of selling that commodity to someone else at some later point in the cycle. Now, we invest over the entire cycle. We think, therefore, as a result, there's no real merit in holding commodities over a complete cycle. If you think you can time the marketplace and time the cycle, there might be times to hold commodities in your portfolio, but you won't see them in AJ Bell portfolios. And the reasons for that are shown nicely on this chart here. What you've got is, thanks to our friends at Investec, you've got a range of asset classes looking at the returns, real returns on asset classes, and the demonstrated volatility. Now, if I take a look at these, what you see is what you would expect. In most cases, when you plot return versus volatility, you expect that parabola shape. Except, of course, commodities stands out for all the reasons I've already talked about. But then we've got these asset classes down here, which are doing something strange as well. Now, you may legitimately look at that and say, aha, I've found basically some golden eggs here. If I buy property, hedge funds, and infrastructure in my portfolio, I'm compensated with exceptional rates of return, but not high levels of volatility. Now, I would question that, and I would ask you to question it as well. What I actually believe we're seeing here is not excessive levels of return for low volatility. What we're seeing is the illusion of low volatility. It's actually, what you're witnessing here is not low volatility, but poor liquidity, because property, hedge funds, and infrastructure are not liquid asset classes. And because they're not liquid, trades tend to take place much less frequently. And because they're not liquid, people don't tend to cash these portfolios in the event of portfolio distress, except, of course, when you're really distressed and you do have to cash them in, that's when you hit with a liquidity premium. And we've seen this time and time again. That's why property funds were closed during the stress periods of the financial crisis, and more recently during COVID. It's why hedge funds don't allow you to get access to your money. It's why infrastructure projects don't tend to give you access. And you can apply that to a whole range of different asset classes and investment opportunities that you've witnessed during your careers. Who remembers EEA life settlements? That was low volatility, wasn't it? No, it wasn't low volatility at all. It was the illusion of low volatility. And even structured products, also callables, which look as if they're low volatility until the point when you really want them to be low volatility and behave like bonds, and suddenly they behave like equities. So those asset classes there, again, we would question whether they ought to be in portfolios, because what you're looking at there is not low volatility, you're looking at poor liquidity. So let's bring all of this together. We've gone through all of our risk spectrum here. And what we've also done is we've said that there is different levels of uncertainty within these asset classes themselves. If I quickly just have a quick tour through property, you can have a prime property with a sitting tenant and the ability to increase your rents. That's an index-linked bond. Alternatively, at the other end of the spectrum, you can have a kind of speculative property which is has no tenant and may not receive a tenant. That's much more uncertainty, and as a consequence, you would expect higher returns, but accept the uncertainty that comes with that. Now, if we take all of that and we mash it all together, so we've now got our expected rates of return, our expected levels of volatility, and we also kind of project onto this levels of correlation between the asset classes, we can now start to build some portfolios. And that's where these chaps come in, your risk profiling tools. And there's a myriad of risk profiling tools out there. We're not expressing any particular preference for any of these. These are the 6 that we map our AJ Bell portfolios to, and we'll be producing a blog shortly on this to talk about the variances in the different risk profiling tools. But fundamentally, risk profiling tools are psychometric tests. Now, I'll happily give prizes for anyone who knows who these 2 ladies are. Chances are you don't know them by sight, but you definitely know them by name. So let me tell you their names. On the left, you have Isabel Myers, and on the right, you have Catherine Briggs. And I've given their full names because there's actually a well-known relationship between the 2 people. They are, of course, the eponymous creators of the Myers-Briggs Test, but Isabel is actually also Catherine's daughter. And the story behind the Myers-Briggs Test is actually a really interesting one. It goes back to when Isabel was doing a political science degree, and she would bring potential suitors home to meet Mum, who was a bit like kind of, the Pride and Prejudice cast, Catherine wanted to assess whether the potential suitors were suitable matches for Isabel. And it was that kind of conundrum and that question that made them start to think about personality types. Now, neither Catherine nor Isabel had any schooling whatsoever in psychology. They have no understanding of statistics. They have no understanding of psychometrics. But for whatever reason, thanks to an accident of history, there are 2 million people who take the Myers-Briggs personality test on an annual basis. It's the most sought after and most talked about personality and psychometric test in the entire planet, but it has no statistical value whatsoever. It's a horoscope for intellectuals. So if you are, if you are someone who pays attention to the Myers-Briggs personality type, or indeed if you're using it in order to assess people whether they're suitable for your organization, you are participating in the greatest misallocation of human capital the world has ever known. But I would say that I'm an ENFJ. Use these psychometric tests, and you should be using these psychometric tests because they are statistically valid. If you're making your own psychometric tests to assess your own clients' risk profilers, you're participating in the Myers-Briggs phenomenon. It's horoscopes, and I'd really kind of suggest that you ought not to be doing that. Sign up to one of the risk profiling tools, understand the risk profiling tools, and understand how it matches clients to their perceived level of accepting risk. Now, our friends at Vanguard will show you a bit later on kind of what the returns will be for a standard 60-40 portfolio in historic times. But if we run through the exercise that we've gone on today, and we apply all of these rates of return to a 60-40 portfolio today, in 2022, your expected return on a 60-40 portfolio is more likely to be about 4.8%, not the 7.5% that you've seen historically. And that's really important because you have to ensure that for a balanced level of risk, that is the rate of return that you're talking to your clients about. Now, of course, you use your risk profiling tool for a whole kind of series of purposes, including kind of what's your perceived level of accepting risk, and how much risk would we need to take in order to meet your goals. And those risk profiling tools are really useful for stimulating that sort of conversation. But that's our expectations of a 60-40 portfolio. And if you apply that wider to the range of AJBL portfolios, what we see here is the range of expected returns from cautious all the way through to global growth. Now, volatility means nothing to clients, which is why when we talk about the range of returns on our portfolios, we never ever talk about volatility. But you can use volatility to talk to clients in a language that they will understand. So let's take our ventures portfolio here. The expected return is around 7%. And thanks to the volatility score that we know on this portfolio, we know that in a really, really good year, you might get around 25% return. And in a bad year, you might get a minus 10% return. But using that volatility score, we can also describe to the client what happens in a really, really bad year in a stress scenario. And when you talk about portfolios through this lens, rather than just expected returns and volatility, which means nothing to clients, we find this is a much better tool for having those discussions about risk, return, expected portfolios. And once you've built these portfolios, you can deliver those returns, deliver on those goals, deliver on those dreams for your clients. Hopefully that's been of use. I'll hand you back to Marcus. Thanks very much.
Thank you, Kevin. Any questions you may have for Kevin, pop these into the chat box or make a note on your feedback form at the end of the session, and we'll get back to you. Our next speaker this morning is Ben Pearson, Portfolio Consultant at BlackRock, providing an overview of the key differences between ETFs and index mutual funds. Ben will look to dispel some common myths surrounding ETF investing and focus on a few examples of ETFs being used in portfolio construction. I am pleased to welcome our first guest speaker of the day, Ben Pearson.
Hello everybody, and thank you very much for having us today. My name is Lucy Langley and I sit in the UK sales team here at BlackRock. and I work with UK wealth managers and private banks on implementing and educating around ETFs within their portfolios.
And my name's Ben Pearson. I'm a portfolio consultant in BlackRock's Portfolio Analysis and Solutions team, and we work across the full spectrum of wealth and institutional clients across EMEA as their partner in portfolio construction, with the overarching goal of trying to help them build better portfolios. And a key aspect of this is helping our clients to see the impact of getting more granular in their portfolio's index exposures through ETFs.
Great, so today we've been asked to talk about portfolio implementation using ETFs. So given Ben's day-to-day role of helping clients do this, what we want to do is spend a bit of time taking you through 3 live examples of where we've helped clients use ETFs in their portfolios for better portfolio outcomes. And I will also spend a little bit of time on some more ETF education content, as well as dispelling some myths that we often hear around ETFs from our clients. So on the first slide, if we go to that, I'm going to start with quite a basic slide, which you'll see here. And essentially, I'm not going to tell you how an ETF works, because I think a lot of you that are listening to this will know that. But fundamentally, an ETF is diversified exposure to a broad market index. And you know, the real beauty of an ETF is the structure of that, which allows for really flexible trading and access and operational features. So a few key highlights I want to bring out to kind of head up this presentation, especially versus some of the more traditional instruments you may use, such as index mutual funds, active mutual funds, and underlying stocks and bonds. So number one, I think, is as Ben mentioned in his introduction, is that flexible access and range. There's not much that you can not get an ETF on these days, and they also have things like hedge share classes, etc., which are really important to allow investors for that purity of view. Number 2 is liquidity. So the ETF structure and the ability it has to trade on the secondary market really allows investors a cheaper way to access exposures that may be more expensive in more traditional access vehicles such as index funds. So think about corporate bonds, for example. Thirdly, it's that transparency point. So ETFs have a daily transparency on holdings, which means asset allocators, especially in markets such as that we have at the moment, you get daily look through on exactly what you're holding in your portfolio, which is really important for control of asset allocation. The final 2 are very similar to index mutual funds in terms of diversification. One trade allows you access to a lot of different underlying securities. And then the last one, cost effectiveness. So versus some active mutual funds that you may see, you know, the general TDRs of the ETF industry are very low, which allows essentially better portfolio outcomes for clients.
So in terms of how we'll look at the illustrative examples at a portfolio level, as we move on to the next slide, we'll kind of be able to give an overview of the 3 different flavors in which we're going to pursue this kind of outcome-oriented framework to think about how the granularity of index exposures can help you achieve those portfolio outcomes. So the first one is inflation protection and duration management through short duration dollar treasury inflation protected securities and through dollar floating rate bonds. The second example will be equity selectivity through world factors and US sectors. And then the third example is sustainability, where we look at transitioning wholesale, the equity and fixed income allocations in the portfolio. So I'll illustrate the impact of each of these changes in each example through metrics produced using BlackRock's proprietary investments and technology platform, Aladdin. So on to what we'll be using as our illustrative asset allocation on the following slide. Obviously, to see the impact of each of these changes to asset allocation, we need somewhere to start. So what we have here is, whilst not an actual portfolio, it is fairly illustrative of the average kind of balanced asset allocation we would see in the UK from our clients. So it's around 60% equity, about 30% fixed income, and the balance made up of alternatives and cash. And you can see the more granular asset allocation at the bottom there. So on to our first example of inflation protection and duration management on the following slide. And obviously, inflation is a hugely important topic in markets, even prior to the escalation of conflicts that we've seen in the Ukraine, but all the more so now given the impact on energy markets and the associated pass-through into inflation. So that topic around inflation protection and duration management in the context of a hiking central bank cycle is hugely important. On the following slide, we see the substitutions that we're making. So the overarching outcome that we're looking to achieve here is to build in inflation protection whilst managing rates risk via duration, and also remaining mindful of any impacts from an FX perspective. We do this simply through fixed income in the example, so we keep equity, alts and cash unchanged, but we evolve our starting fixed income allocation using two granular index exposures available via ETFs, and those are, as I mentioned, short duration tips and floaters. The two different examples, the underlying exposures are the same, with the only difference being in the first, we leave that dollar exposure that we brought in unhedged, and in the second, we hedge it back to sterling. So as we move to the following slide, we see examples of the impact that we have across a number of different metrics. So on the left-hand side, we see the impacts from a risk perspective, and here we're looking at risk contribution over a 1-year horizon. And whilst we see, looking at the sort of left-hand bar of that left chart, the illustrative asset allocation, when we move across to the two options from a kind of total portfolio risk perspective, those are broadly similar. We see maybe a 10 to 15 basis point reduction in risk over that 1-year horizon. But it's the makeup of that risk that I want you to focus on and the change that we see there. So in that central bar, you'll see an increase in the pink section there, which is the FX risk that we're onboarding from implementing these exposures unhedged. We see that that FX risk is actually absent in the bar to the right of that as a function of hedging those onboarded exposures back to sterling. And actually the FX risk that we do see, if you really squint at the bottom of that chart, underneath the 0 line, there's a negative risk contribution coming from FX. So I think this example highlights really well how that selectivity of to hedge or not to hedge, particularly for fixed income exposures, has a big impact on total portfolio risk. But in terms of rates and inflation, the impact is maybe a little bit more subtle. So we explore that through the scenario analysis on the right-hand side. And here we're looking at two hypothetical scenarios which assess the impact of higher inflation catalyzed by the energy transition. And whilst it's a broadly speaking kind of risk-off scenario with risk assets like equity, that's the orange section, drawing down pretty significantly, you see a bit more nuance from some of the other factors. And honing in on rates in yellow, what we see in the first bar of this chart is a drawdown from our illustrative asset allocation coming from that yellow section of rates. As we move to the two bars to the right, we see that disappear largely as a function of taking that deliberate shorter duration approach. Likewise, and it is only a sliver, but it is an important sliver, you see a little bit of improved P&L on the upside in terms of the inflation protection piece. So that sliver of purple that we're onboarding there is an illustration of how that inflation protection comes through at a portfolio level. FX impacts also quite important here, as you can see from the sort of relative P&Ls. But I think the overall kind of I think key takeaway I would call out here is the ability to achieve greater inflation protection, manage rates risk via deliberate targeting of shorter durations, and also have the choice to implement with FX exposures hedged or unhedged to align with the desired outcome.
Great, thanks very much, Ben. And yeah, I think just reiterating those points, the flexibility of the exposures we have in the ETF range is extremely important. These keep on evolving, each and every month. And also just a point that is maybe less evident here is the liquidity point. So I mentioned before about being able to save costs in terms of trading ETFs versus traditional vehicles, and this, given it's a fixed income underlying, would really come into its own here. So on to the next slide, where I'm going to do a bit of myth busting around fixed income ETFs, because I still get a lot of questions around, are fixed income ETFs going to blow up the world, etc. Which obviously the answer here is no. And to put it in perspective, these two charts I think really speak a lot of volume. But fixed income ETFs still only make up about 1% of the overall bond universe, which is really, really important. Obviously, it depends a little bit per asset class within fixed income, inflation a little bit more, government bonds a little bit less, but they're still a very small amount of the overall universe. And on the next slide as well, I'm just going to take you through one of the stress tests that we've obviously had in the industry, which was last year of COVID-19. And if you see the chart on the next slide, which is in red, what we're having a look at here is across March 2020, how many times the underlying bonds of one of our flagship ETFs, our dollar corporate ETF, traded per day across that month. And you found that 50.4% of that benchmark only traded between 0 and 5 times per day on average in that month. This is in stark contrast to what we saw on the ETF secondary market liquidity for that ETF, where we saw it trading hundreds of thousands of times per day, really showing how ETFs really held up in that period and how it was a really efficient way for clients to move risk during that stress period of underlying market. So back to Ben on the next slide with the next portfolio example.
Perfect. So moving away from fixed income and onto equities, obviously there's been a kind of huge debate and huge movements in markets in terms of the kind of value versus growth rotation, likewise cyclical versus non-cyclical sectors and how to position. So in that context, we look at equity selectivity through the lens of both factors and sectors. So on the factor side, we look at world value and world quality sectors, and what factors, world value and world quality factors. And then on the sector side, we look at US energy and US financials. So onto the following slide, the illustrative example in terms of an outcome we're looking for here is to tilt equity style exposures and also to seek to tactically improve risk-adjusted returns through that factor and sector selectivity. So we do that just in the equity context here, so leaving fixed income, alts and cash unchanged, but we prorate down our starting 60% equity allocation to around 40% to make room for these additions. Initially, as I mentioned, a split between world quality and world value factors, and then in the second example, US financials and US energy sectors. So looking at the impact of these, I firstly sort of have to show you the year-on-year performance on the following slide. From a compliance perspective, but kind of moving past that to some more relevant metrics on the slide after, what we'll see is on the left-hand side, the impact from an equity style factor perspective. So keeping that headline outcome that we're looking for front of mind, firstly, just before thinking about honing in on any particular factor, what we see looking at the orange bar here of our starting asset allocation versus yellow and green, where we evolve through factors and sectors, we do see tilts in each of these different factors. So we're certainly kind of ticking the box there in terms of being able to move these factor exposures. But honing in on two in particular, which are highlighted on the chart, and that's value and profitability, particularly if we look at the yellow bar, which is our factors evolution, we see quite clearly that relative to our starting asset allocation in orange, we're able to tilt both our value and profitability factor exposures upwards relative to the starting point. And also, I think worth noting is that even when we're choosing to implement through sectors in the green bars on this chart, you see that that also has knock-on impacts in terms of factors. So I think that point around granularity of index exposure, even if the goal that we're looking for is to tilt factors, you can choose to implement that through both explicit factor exposures, but also implicitly through sectors. And on the right-hand side, we see the impact from a performance perspective. And we're looking here 2020 to date. So obviously, significant drawdown in March 2020 as a result of COVID, the subsequent recovery. And then I think from 2021 onwards, really kind of highlights the pace at which that recovery progressed and that rotation into value and into things from a sector perspective, like energy and financials. And we really see that picking up in terms of performance. So again, contextualizing with that top level target of tactically improving risk-adjusted returns, we see that coming through here. And likewise, in terms of the Sharpe ratios at the bottom of the chart, very significant improvements versus our starting asset allocation when we're looking at the sector implementation, and also some marginal improvements for factors as well, particularly on the 1 year and in mark. So I think the key thing to highlight here is that point around equity selectivity and having the flexibility to do so via precision exposures like sectors and also like factors, but also having different regional overlays to those as well.
Great, thanks, Ben. And I think I'd also just highlight the transparency point here that I mentioned at the start. You know, sector and factor ETFs obviously give daily holdings, which means that you don't have to say, you know, how value is this value ETF. You can actually look at it in your risk systems, loading into FactSet or Style Analytics or something like that, and actually see for yourself what you're adding to your portfolio and measure that on a daily basis. So on to the next slide, just a very quick chart in terms of the evolution of the equity ETF investor. And as you can see, like as investors have got more and more comfortable with ETF usage, we've really seen that percentage of investors using things like sector ETFs, which is represented within the purple bar, factor ETFs in the yellow bar, and also thematic ETFs in the green bar has really increased, especially over recent sort of years as, you know, sector performance has really diverged. So, you know, investors are really looking to use these instruments for their benefit, for better portfolio outcomes. And on to the next slide for Ben's next example.
Yeah, thanks, Lucy. And I think that point around kind of evolving preferences and more granularity of exposure comes through really well using sustainability as a concept. So obviously it's something that's hugely important for pretty much every client I speak to in our portfolio consultations, whether it's in the context of building completely new propositions or looking at evolving existing ones to become more sustainable. But it's that granularity of exposure to be able to manage those trade-offs and which vehicle to use to do so that really is kind of where we focus most of our attention when we're speaking this through with clients. So in this example, we transition both the equity and fixed income elements of our starting asset allocation into sustainable equivalents. And on the following slide, we kind of see how we do that in practice. So the overarching goal here for our final example is to improve sustainability characteristics for minimal tracking error impact. And as I said, that's the key trade-off that we're often exploring with clients. So in the first example, we do so just through evolving the equity allocation. So we leave the fixed income, alts and cash unchanged for now, but we evolve each of the regional equity building blocks into a sustainable equivalent. And then in the second, we do that same exercise with equity, but also try to move as much of fixed income across as we can. So gilts needs to remain unchanged, as does alts and cash. But here we swap out our international bonds exposure for an ESG version of global ag. And likewise, on the sterling corporate side, we incorporate an ultra short ESG exposure. And I think this particular exposure is a great example of blending that concept that we introduced in the first example of shortening duration to manage your rates risk. But also here, you're able to combine that with an ESG exposure. So I think a great example of the kind of breadth of range that's able, that you're able to make the most of to access different exposures in the same single line item. So how does that manifest itself across a number of different metrics? And we'll see this on the following slide. On the left, we focus firstly on sustainability characteristics. So if we look at the bars, we can see from an ESG score perspective that we see quite a steady improvement as we sort of initially evolve just the equity portion, so moving from orange to yellow, and then when we also incorporate fixed income transitions from yellow to green. What we see is around a 10% improvement in ESG score as we make our equity transitions. That then improves to around 15% when we make our fixed income transitions. But I think the more important and I guess more impactful change that we see here is in terms of the carbon emissions intensity reduction. And that's the markers on this chart. And we see that that reduction from orange to yellow, i.e. moving just equity, is around a 40% reduction in carbon emissions intensity. That improves to just over 50% when we also move across fixed income. And I think from a sustainability characteristics perspective, very clear that we've ticked the box in terms of making those improvements. But what's that coming at a potential cost of in terms of tracking error? And that's what we look at on the right-hand side. So again, we're looking at this risk contribution over a 1-year horizon. But on the right-hand side, we highlight just the tracking error or active risk of each of our 2 options versus our starting asset allocation. And what we see here is we have to take around 1.5% of tracking error or active risk over a 1-year horizon to achieve these sustainability improvements. And I can say kind of from the context of looking at this sort of problem with a lot of clients that that trade-off is broadly speaking quite happily accepted by clients to achieve that degree of improvement. As I said, around a 50% reduction in carbon emissions intensity in this example. So it's an important trade-off to understand. And again, I think that granularity of exposure and having the choice in terms of your provider of choice to be able to make that selection of the kind of desired index methodology that will marry together your desired outcome from a sustainability improvement, but also from a tracking error perspective is also really important and the key thing to focus on here.
Thanks, Ben. And I'd also add cost effectiveness, I'd say, in terms of the ETFs used. A lot of our ETFs take the Global Ag ESG that Ben brought out is actually the same price as our non-ESG versions, which is really important to us here at BlackRock. On to the next slide. One thing I hear a lot is how can I make any impact in my passive holdings if I can't divest? And this is where BlackRock Investment Stewardship and the stewardship industry as a whole really makes an impact in terms of passive holdings. And passive investors by nature are long term and therefore cannot divest, which means we have a seat at the table in terms of engagement and voting with these firms to help them transition to a better future. So there's various stats in terms of outcomes on here, which I'll leave you to digest. But two stats I'd pull out is our investment stewardship team across the firm had over 3,600 engagements with over 2,300 companies last year, and we voted against directors at over 42% of meetings that we were in last year, which is really important. So big impact with your ETF holdings.
So the final slide, conscious we've had a pretty whistle-stop tour of outcome-oriented implementation. So I'm not going to go through these again in detail, but I think just for your illustration, again, just to kind of refresh the topics that we've been through here. But hopefully it's proved useful to kind of highlight how getting granular in your index exposures and potentially implementing these via ETFs could help you to achieve portfolio outcomes.
Thank you very much. And I think just on the last slide, very much an open forum for any questions. Do please feel free to submit any feedback on your feedback forms or add any questions in there. We're more than happy to help with any follow-ups from this presentation. We're really excited to see how investors are using ETFs in more innovative ways year on year, and we look forward to helping you with this. Thank you very much, everybody.
Next up is Head of Asset Allocation Europe at Vanguard, Giulio Renzi-Righi. Looking at portfolio drift, Giulio will address how this persistent threat, if left unchecked, could lead investors exposed to unwanted risk. He'll look at how rebalancing portfolios is an effective solution to mitigate some of these risks when portfolios should be rebalanced, and how you might implement a rebalancing strategy for clients. Ladies and gentlemen, Giulio Renzi-Righi.
Good morning and good afternoon, depending on when you're watching this, to everyone. I am Giulio Renzi-Righi. I lead the asset allocation team in Europe for Vanguard. And today I'm going to talk to you about rebalancing investors' portfolio. This is probably like a topic that is more relevant than other times. During extreme market volatility, rebalancing a portfolio might have some advantages and might be a good practice, but it's not necessarily something that all investors and advisors are familiar with. So today I'm going to focusing on some of the best practices associated with portfolio rebalancing in a multi-asset portfolio. Let me start by showing you what the best, worst, and average performance from an historical perspective has been for different type of portfolios. And here really we're looking at the equity bond mix between different portfolios, starting from the left, from a portfolio that is 100% bonds, and to the very right, a portfolio that is 100% equities, and any mix, any blend of the two in the middle. And what we're showing here is the historical numbers starting from 1901 until 2021. The numbers in the middle refer to the average annualized return for the different equity bond mixes, and the upper and lower bounds refer to the best and worst annualized performance. So here really the point of this slide is to show you that depending on the risk that you want to take into account and that you want to bear in a multi-asset portfolio represented usually by the riskier asset class like equities, will really lead to higher returns and lower returns, but also the level of risk that you're bearing in terms of maximum returns and worst return. So here really is the first message is about knowing what your risk profile is, what is the amount of total volatility and performance that you're willing to take into account. And as you can see from an historical perspective, equities have led to higher returns on average, but also with higher dispersion of that performance. And this is something always that is worth to keep in mind, and that will become especially relevant once we move into rebalancing strategies. Now that we know, I mean, again, something that you guys are familiar with, the fact that equities can be, of course, more and more volatile and riskier than bonds, but also lead to better returns. Let me show you another chart, which is about the weight in a 60-40 portfolio, at least a portfolio starting to be a 60-40, so 60% equity and 40% bond in 2003. And here really I just picked like a window and horizon that is reasonably long enough, but it could have been any other time horizon. So here I'm showing what the weight, the asset allocations, the weights in the equity component would have been from 2003 until 2022 if you were starting from a 60-40 allocation. The blue line represents the asset allocation, so the exposure to equities if you were rebalancing on a quarterly basis, so if you were reverting back to a 60-40 allocation every quarter, whereas the red line represents the allocation and the weight in the equity component if you were not rebalancing the portfolio, so if you were letting the portfolio drift over time depending on the evolution and performance of the stocks and bonds. And here really we're looking at a global portfolio, so global bonds and global equities. And as you can see, started from 2003, if you were not rebalancing, so if you're looking at the red line, you would have drifted very easily after a few years to an allocation that has a significantly more equity exposure. So started from a 60% roughly in 2007, 2008, you would have reached levels close to 75% equity exposure. Now, of course, you would have dropped back below target during the financial crisis due to the large downfall of equities, of global equities. But then, as you can see from the recovery, so starting from 2009, 2010, that equity allocation, if you didn't rebalance, would have drifted again, reaching levels again around 80, 85 in recent years. Whereas if you were looking at a portfolio that was rebalanced on a quarterly basis, except for the period around the financial crisis where there was a lot of volatility and turmoil, where you could have deviated quite substantially from the 60-40 mix, it would have kept you in line pretty much on your target allocation that you started with. So what is the main message about this? Well, the message is that if you're not rebalancing on a regular frequency or following certain rules that we're gonna discuss in a few minutes, your portfolio might look very different over time, depending, of course, on the performance of the assets that are part of your portfolio. And the risk here is that you might end up after several years with an allocation that is very different than your investors' objectives in terms of not only risk exposure and risk profile, but also in terms of performance. If the objective, for instance, is associated with withdrawing money from your portfolio. So you might have exposures that are way easier than what the investors might be willing to accept. Now, let me combine the two charts that I just showed you. So the fact that, generally speaking, over time, over a longer period of times, equities tend to perform better than bonds, the safer asset classes, but also with more volatility, with wider dispersion, and the fact that over time, if you're not rebalancing, your portfolio might drift towards allocations that are higher than what they're meant to be or that are consistent with your risk profiling. So in this chart, I'm combining these two, the previous two slides together, and I'm showing you the difference in the volatility between the rebalanced portfolio and the unrebalanced portfolio. So again, starting from a 60-40 allocation for the portfolio rebalancing and looking at what the difference in the 6-month rolling volatility, annualized volatility, would have been from 2003 to 2022. As you would expect, given the two conclusions that we drew from the previous two slides, close to the global financial crisis, you would have reached a higher volatility exposure on a rolling window basis that is more than 3 percentage points higher than what it could have been if you were rebalancing your portfolio on a quarterly basis. Then during the financial crisis, that actually would have dropped, so you would have been facing the opposite problem, so to speak, in the sense that the rebalanced portfolio would have had a higher volatility. But then, as soon as the recovery started in 2010, you could see that on average you would have been exposed to 1.5, 2%, and more recently around 3 percentage points more annualized volatility on an ongoing basis, just for the fact that you were not rebalancing, and by not rebalancing you were taking more and more exposure towards riskier assets, with peaks more recently that can even reach like 7.5%. So again, this is a message saying that one of the key principles about portfolio rebalancing and keeping on track to a target asset allocation is really to make sure that we can manage the risk exposures of an investor's objective and targets, and not so much about outperformance or generating returns. So that is always important to keep in mind, because it's really one of the key principles of portfolio rebalancing, independently of the frequency and the rules that we might be following. You want to rebalance a portfolio to your target allocation such that you can keep your portfolio, your multi-asset portfolio, in line with the objective that you originally defined, and making sure that independent of the market environment, situations, and level of volatility, you keep track of that risk profiling that you initially identified for the client or for your objective. Really, portfolio rebalance is not so much about maximizing return, is really to keep track of risk and managing risk on an ongoing basis. So now that we discussed why we need portfolio rebalancing, why it is important to have a portfolio rebalancing, what is the key message around it, let me give you a bit more context on what are some of the approaches, the strategies that can be followed in order to implement the rebalancing strategies. And we identified 3 key ones that are quite straightforward and can be used in different moments, in different periods, also with different type of investors. The first type of rebalancing strategy is what we call a time-only rebalancing strategy. This rebalancing strategy is based on the fact that you would be looking at discrete point in time that can really depend on your objective and your investor. So you could look at what happens on a daily basis, on a monthly basis, or with lower frequency, so on a quarterly schedule or annual schedule, and you would rebalance only on those specific points in time. So the only variable really that is taken into account and that matters is time. And the time-only strategy really does not look into how much the portfolio has been deviating from your target allocation, positively or negatively. So it only matters rebalancing independently of the magnitude at specific intervals. So if you're, for instance, on a quarterly basis, you decide to rebalance your portfolio, it wouldn't matter whether on a 60-40 portfolio, for instance, you would be deviating from 2 percentage points, 5 percentage points, or 10 percentage points. You would always rebalance to target on a quarterly frequency. The second strategy is what we call the threshold only. So that's almost the opposite of the time only rebalancing strategy. And that follows the principle that you would rebalance to the target asset allocation by a specific minimum percentage. That could be a 1 percentage point, 5 percentage point, or 10 percentage point. So that would be the window that triggers the rebalancing strategy. So opposite to the time only, the only thing here that is taken into account is really the magnitude of the deviation from the target asset allocation, and it doesn't take into account any frequency in the rebalancing schedule. However, it does require the investor to look at the asset allocation and the thresholds on an ongoing basis, so almost on a daily schedule. The way that it works then is that if I start from a 60-40 portfolio, for instance, I would rebalance every time that the portfolio breaches the thresholds of 55% equity exposure and 65% equity exposure if the minimum percentage threshold is 5 percentage point. And that could happen once a quarter, it could happen twice a quarter, it could only happen once per year, really depending on the volatility environment that we're facing. The last technique, the last strategy is a combination of the two. So you would base yourself on minimum threshold, similar to the threshold only strategy. So rebalancing at specific deviations from the target asset allocation. That could be 1 percentage point, 5 percentage point, or 10 percentage point, but that would happen again on single period in time. So it's really a combination of the time only and the threshold only. So you would rebalance the target asset allocation following a specific schedule that could be quarterly, annual, or monthly, but only if the target asset allocation deviates more than the predetermined amount. This strategy really has the benefit of combining the two previous strategies that we discussed. It also allows for looking at the target asset allocation and rebalancing strategies with an approach that is both consistent with keeping costs low, especially if we look at the predetermined amount as a function of the strategy, but also does not necessarily require the investors to monitor the portfolio on an ongoing basis, on a daily basis. So it's really try to capture the best of both worlds. On top of rebalancing strategies, there are other aspects that investors can take into account in order to adopt their best approach for rebalancing to the target asset allocation. And here in these slides, we're really trying to capture 3 key items. The first one is rebalancing to the target asset allocation using portfolio's cash flows. That means that if, again, for sake of simplicity, we're starting from a 60-40 portfolio and now the asset allocation has drifted to a 70-30 portfolio, so I'm overly exposed, I wouldn't necessarily need to sell assets in order to go back on track to the 60-40 allocation. Instead, then investors could use the portfolio cash flows in order to readjust that asset allocation. So inflows such as lump sum amounts, dividends, and interest rate payment can be used and directed to underweighted asset classes, whereas withdrawals from the portfolio should start with overweighted asset classes. Again, keeping in mind and using cash flows, both negative and positive, in order to rebalance the assets in a way that it could be easier for investors to take into account and to keep track of the asset allocation without having to sell assets and possibly to endure higher costs. And of course, cost is one of the elements also to keep in mind. So always being mindful of cost. One strategy, one approach to keep costs low in this scenario is adopting a strategy that is not committed to rebalancing fully. So again, if I'm a 70-30 portfolio, I might not necessarily want to rebalance that to 60-40, but I might rebalance only to a certain limit to keep within a certain threshold. So I might want just to sell assets or to use cash flows in order to go back to a 65% allocation rather than 60% of allocation. That would allow me to reduce the cost that would be incurred if I was not following that practice. Last but not least is starting and thinking about rebalancing from tax efficient accounts, like for instance ISA accounts. What does that mean? Let me provide a bit more clarity here. That here means that you really have to look at the portfolio from an holistic perspective. So all the assets that would be within a remit, both in tax efficient accounts and non-tax efficient accounts. And so trying to skew and to consider rebalancing strategies in tax efficient accounts, because those would not really incur, for instance, tax on capital gains that you would have in a non-tax efficient account. So looking at the complexity of the entirety of your portfolio and blending the rebalancing strategy in a way that overall your portfolio through tax efficient account and non-tax efficient account is consistent with your risk profiling, is consistent with your objective, but taking care as much as possible of the rebalancing in order to keep all your portfolio on track, starting from the tax efficient account, such that you could reduce your tax costs. Now, we have been talking a lot about best practice, why rebalancing is something that all investors should consider to keep track of their investment objective and risk profiling. We'll be talking about best practices for rebalancing strategies and what to keep into account also in order to keep cost low and in line with the different type of accounts that investors might have. In the last slide, let me highlight some of the benefits that might be associated with rebalancing from a risk-adjusted standpoint. So in this slide, I'm reporting the risk-adjusted return for global 60/40 portfolios, ignoring costs. So in this case, we're not looking at trading costs or rebalancing costs associated with the portfolios, and how the risk-adjusted return changes for different type of strategies. Now, the chart that you see, each of these boxes, it's a box whisker plot. So the white dot in the middle shows the average risk-adjusted return based on our forecast, on our Vanguard forecast for a 30-year ahead horizon. That is basically our risk model. So it's the model that we would use in order to forecast what the asset returns would be into the future for different type of asset classes. And the reasons why you have, well, the box and the whiskers in this chart is because our risk tool, our forecasting tool, look at a series of different scenarios. So it's not a one-point forecast, but uses Monte Carlo simulations in order to provide an idea of what the distribution of the different performance and returns of asset classes might be. In more precisely, we're looking at 10,000 different simulations of what returns and risk might be into the future for different asset classes. So the top of the lines, so the top of the whisker and the bottom of the whisker, those represent the 5th and 95th percentile of that distribution, whereas the red boxes, those represent the 25th and 75th percentile of distribution. As I said earlier, the white dot in the middle is the median forecast. Now, based on our VCMM forecast, so basing on our proprietary forecasting tool, we look at different strategies. The box on the left represents the risk-adjusted return over a 30-year horizon for an investor that does not rebalance a 60/40 global equity bond portfolio. And that risk-adjusted return is around 23%. Now, the rest of the box whiskers show first what the risk-adjusted return could be for a portfolio that is rebalanced on a quarterly basis using different thresholds. A 0% threshold, a 1% threshold, 5 and 10% threshold. Again, here we're looking then at two strategies, right? Is time and threshold strategies. And equally, the last 4 box whisker on the right represent an investor who would be rebalancing on an annual basis, but still using the threshold amount that I just mentioned. So 0, 1%, 5 percentage point, and 10 percentage point. Overall here, the picture is that although there are only small differences, the picture is that based on our forecast, it would be optimal to rebalance as frequently as possible on a quarterly basis and using the lowest possible threshold, so a threshold around 0% or 1%. So really not allowing for much deviation from the optimal 60/40 target and doing that as frequently as possible, at least on a quarterly basis compared to annual. But we do see that the differences are quite small, are reasonably limited between the different strategy, but definitely there is a large difference between what you might get on a risk-adjusted basis from strategies that do follow rebalancing and threshold compared to a portfolio that is never rebalanced. So for instance, if we take the two-box whisker on the left, that would be a portfolio that has a risk-adjusted return of 23.5% for an investor that never rebalances, and that risk-adjusted return could be improved to 27.4% if instead that portfolio was rebalanced on a quarterly basis with a low threshold. So again, here highlighting the benefit of rebalancing based on our forecasting tool, but of course ignoring cost, which would change the picture of this analysis. But again, as there is no optimal portfolio depending on an investor's objective, so there isn't such a thing as the golden rule on what the optimal asset allocation might be for any investor. It really depends on the objective and the risk profiling. Similarly, it's hard to identify an optimal rebalancing strategy that could work for anybody. Is really a function of what, again, the investor profile is, the risk tolerance is, their objective, and also in terms, especially if we look into cost, what would be the asset classes, what would be the asset allocation, and the type of investments that the investors is willing to take. And consideration might be around whether the asset allocation would entail liquid assets or less liquid assets, and also in terms of rebalancing cost, it would be a function of the market environment and volatility. Cost might be higher in more volatile environments and lower in less volatile environments, and this is something that the benefits of more frequent rebalancing might need to be considered along with trading costs. Thank you for your time, and see you soon.
Thank you, Giulio. Again, any questions or follow-up required from the Vanguard team, drop into the chat or pop up on the feedback at the end of the webinar, and we'll get those questions to Giulio to come back to you. So, before we conclude our final sessions today, we'll give you 5 minutes to top up your drinks, take a comfort break, and we'll see you shortly. Welcome back. Next up is the delightful Carla Langley from Langley Consultants. Carla will look to bring together some of the information discussed so far today and will address the importance of good CIP documentation. She'll dig into how your CIP can dictate your independent status or not, and will outline some key risks of a CIP, including agents as clients. Carla, over to you.
Good morning all, my name's Carla Langley and I'm the owner and founder of Langley Consultancy Services. For those of you who don't know me, I typically provide consultancy and hands-on support training for IFA businesses. And today I'm going to talk to you a little bit about, let's bring all of this stuff together. So everything we've heard about during the day, I think it's time to just talk a little bit more about how do we bring it together and what are some of the things we need to think about running your CIP in real life. So I think on that note, let's have a look at the agenda for today and see what topics we're going to cover. So starting point, I think with the agenda today, we will start on actually just how your CIP dictates your independence or not status, and a bit more on that shortly. Then we're just going to talk about the importance of a good CIP and good CIP documentation particularly. So how do you evidence that you've got a good CIP in place? And then we're going to move on just to the risks of a CIP. So we're going to talk particularly about things like agent as client versus reliance on others. We're going to talk about some of the operational costs involved, and we're going to talk about the impact on your business value as well. And then I'm just going to finish off talking a little bit about proportionality and actually what does your CIP need to look like if you're a small firm versus if you're a big firm. So hopefully you'll find that really useful. So I think let's start then with independent status and does your CIP support it? So I suspect that the majority of people who are listening today are independent financial advisors. You work in an independent business. So let's start off with just a reminder of what we mean when we talk about independent advice. So the FCA define independent advice as a firm who informs a client that when it provides independent advice, you assess a sufficient range of relevant products on the market. And when they talk about a sufficient range, they say it must include a sufficiently diverse range of products in terms of type and product providers, and that's to ensure that your client's investment objectives can be suitably met. So I hate quoting FCA rules, but this is straight out of the FCA handbook, and I think it's really important we just understand the definition of independence before we really get going into this session. So one second thing to note on that definition is that you can't be limited to products that are issued or provided either by your firm or other entities that you have close links with, or other entities where you've got close legal or economic relationships with. You have to start from an unbiased position. So I think if we think about that in a nutshell, what does it mean? What does it mean for your firm? Well, it means that you have to evidence that if you're an independent firm, you've started your research process from a wide range of the market. So when you're looking at your CIP, you have to be able to evidence that you've started from that wide range starting point. And you have to be able to evidence that you're not limited to any particular product or provider. And if you do have an in-house solution, so if you are vertically integrated and you've got some in-house solutions, you have to be able to evidence that your research was unbiased. So it doesn't matter that you might use some of your own in-house stuff, but that starting point has to be wide range of the market, and that process you go through has to be unbiased. So why is all of this important then? And what are some of the things that you need to ask yourself when we're talking about independent status in your CIP? I think firstly, one of the things you need to ask yourself is, can you prove that you started the research for your centralised investment proposition from a wide range of the market? Can you prove that? Have you got the evidence for it? And if the answer is yes, the next question is, okay, how did you narrow it down? So how did you go from all the hundreds and thousands of different options that are out there right down to your preferred solution that's in your CIP? So you need to be thinking about, how did we narrow this down, and is this documented? And then you need to be thinking about, how did you decide on the parameters to narrow it down? And why are they relevant? So actually that's the rationale. It's brilliant to say this is how we narrowed it down. These are all the parameters we used, but what was the rationale? How did you decide on those particular parameters and why are they relevant for your particular types of clients? And then from your shortlist, when we're thinking about your CIP, we go, okay, we've got a shortlist. What additional parameters did you then use to narrow down that shortlist to your preferred solutions? And how did you make that final decision on what your preferred provider and your preferred solutions were? And then lastly, one of the things you need to ask yourself is what due diligence did you carry out on your final selection? And don't confuse due diligence with research, because all those other steps, they're your research stages. That's where you go through some of the quantitative analysis, you look at some of the quality issues. But then when we get to the very end of this process, what we need to be looking at is what due diligence have you done on your final selection? So actually started to delve a bit deeper to really understand preferred provider, the preferred products, to ensure that you've got a really good understanding of what it is you're going to be recommending to your client. So you need to be thinking about, can you evidence those things? Have you gone through those steps? And if the answer is yes, actually, we did start from a wide range of the market and we can evidence it, and this is the process we went through, well, that's absolutely what you need to do to be able to evidence independent status. If you can't do that, then you've got a little bit of a problem, because that's the key bit that is going to evidence whether you are or you aren't independent. So when you're thinking about your CIP and we're thinking about where you end up with it and what you end up recommending, go back to that research stage, look at the paperwork you've got and say, okay, are we confident we've got enough documentation here to evidence that we started from that independent point? And then on that note, actually, I think it's probably really useful at this point to just throw in there really quickly, and I won't spend loads of time on this, but really quickly, how does this all work alongside product governance? Because there's been so much, hasn't there, over the last couple of years around product governance, and I think we're probably all product governance out to a point. But when we're talking about your CIP, and we're talking about proving whether you're independent and all of that kind of stuff, there's a real link here to product governance. And that link is, well, firstly, remember the definition of independent status. It says that you have to be sufficiently diverse with regard to the types of products and providers that you're looking at, to ensure that your client's investment objectives can be suitably met. So how do we tie that into product governance? Well, think about it. If you're running a CIP and your CIP is there, it's at the core of your business, it's your preferred solution for the majority of your clients, you have to think about, how does our CIP ensure that our clients' investment objectives can be suitably met? And that's where product governance comes in. Because actually, if you've got a really good understanding of who your clients typically are and what they typically need from you, that then starts to dictate your research parameters within your centralized investment proposition. And then that starts to give you that evidence that actually this preferred solution, this investment proposition we run, will typically meet and be typically suitable for our clients' investment objectives. So it's really important actually that you start to think about product governance at this point as well, and thinking, do we truly understand who our clients are and actually what they need from us? So actually things like, if we're talking about stuff like MPS solutions, DFM solutions, actually what do you think your clients need in terms of regular rebalancing? What does that look like? What are some of the parameters around it? Are most of your clients just ordinary retail clients who don't need complex products? All of that stuff is the really important stuff that sits within product governance, but also sits within inside your CIP as well. So just a bit of food for thought. Have a think about that and think about, can you link it all together? Okay, so I've already mentioned this, haven't I? But let's talk a little bit about the importance of really good documentation behind your CIP, because it's so important. So let's think about then, what do I mean by good documentation, and why is it so important? So firstly, when we're talking about why is good documentation so important, it's because all of that stuff that sits behind your CIP, it's the documentation, as we've just said, that proves you're an independent firm. If you can't evidence that you started from a wide range of the market, you can't evidence the process you went through to get to your preferred solution, you can't evidence that you're independent. So it's that documentation that proves your independent status. It's the documentation that evidences how you assessed if a solution was appropriate and suitable for your clients. It's all that documentation that will potentially help you defend a complaint if you ever got one. And all of that documentation that sits behind your CIP is what proves to the FCA that you as a business have adequate systems, controls, and risk management processes in place. And if you can't evidence how you got from all of those hundreds and thousands of choices available in the market to your preferred solution in your CIP, then ultimately you can't evidence your independence. And you can't evidence that the solution's suitable for your clients. So without all of the documentation that sits behind this and the evidence, it becomes really difficult as a business for you to A, say you're independent, and B, evidence that your CIP is a suitable solution for your clients. So on that note then, I think let's just move on and talk a little bit about, is your CIP your biggest risk in your business? So just think about that for a second. Is your CIP your biggest risk within the business? Yes, I would say absolutely yes. And why is that? The reason it's the biggest risk within your business is ultimately because your CIP is the core of your advice proposition. Almost all of your clients within your business will be exposed to it. And if you make a wrong decision, or you don't conduct thorough enough research, or you don't undertake sufficient due diligence, then almost every single client in your business could be affected by that. And the potential impact for harm could be significant, both in terms of the number of clients, but also in terms of the finances around that as well. So your KIP absolutely is your biggest risk within your business. However, it's a manageable risk, which is a good thing. Just because it's a biggest risk within your business doesn't mean it's a problem, because it's manageable. But all those things we've just been talking about is how you manage that risk that sits around your CIP. So things like having robust research procedures and processes in place can help mitigate the risk of your CIP and the risk of you getting something wrong. Your processes should be repeatable, controlled, documented, and if they are, again, that manages that risk of actually the CIP, you're getting something wrong within there and it affecting all of your clients. You should have thoroughly documented rationale, findings around what you've chosen to do, and you should have thorough due diligence as well. And if you've got those things, again, that's a way of managing some of the risks that sit behind your CIP. And then lastly, having well-qualified individuals within your business helps to manage that risk of your CIP, especially actually if you're running your own portfolios. Having someone who's well qualified at that point is so important to manage that risk within your CIP. So let's delve into that a little bit more, and let's just think about what some of the specific risks are and what some of the specific things are that you need to think about within your CIP. So first place I want to start actually is this whole scenario of agent as client versus reliance on others, and actually understanding how the contract is set up between your firm and any outsourced solutions that you're using. So from a risk perspective, understanding this and understanding exactly what all of this means is vital, because there are some significant risks that sit within the way the contract is set up between your firm and any outsourced solutions you're using. So I think let's just start bit of an overview actually of what we mean by agent as client versus reliance on others. I'm sure most of you will be familiar with this by now, but we'll just do a bit of a recap for those of you who are not. So when we're talking about agent as client, we're talking about how that contract is set up between your advisory firm and the DFM or the DFM solution you're using, whether that be a bespoke DFM or an MPS solution. So under agent as client, you as the advisor firm become the client of the DFM, and there's no contractual relationship between the DFM and the end investor, which is your client. So you are the client When we talk about reliance on others, typically that's a tripartite arrangement. So typically that involves a written relationship and contractual relationship between the DFM and the end investor, the client, and between the DFM and you as the advisor. So there's three parties in that arrangement, and it's usually very clear, and we'll talk about this in a second, who does what and what that looks like. So let's start with agent as client and just talk about that in a bit more detail and talk about some of the things that you need to understand. So why is it so important to understand what this means and actually how it impacts your business? Well, there are some really key things that you need to be aware of with this arrangement, and some things that can directly impact your business and potentially be a massive risk as well. So first thing is if your firm is the client, so think about it, under agent as client, you're the client, the DFM treats you as the client. Because your firm is the client, your firm is considered a professional investor. And in most agreements that I've seen, particularly actually for MPS, for a lot of the MPS solutions out there, within that agreement, it states that you're a professional investor. So the question you need to ask yourself is, if you have an agent as client agreement set up with one of your outsourced solutions, does your agreement state that you're a professional investor? If the answer is yes, it does say you're a professional investor. The next question you need to ask, and you need to go and look at, is does it also state that they, so the DFM, will only invest in line with the retail investor rules? And actually, of a lot of the contracts that I've looked at, a lot of them don't. They don't have that line in to say that they're only going to invest in line with the retail investor rules. And if you don't have that line in your agreement, then you've got a suitability problem. The reason you've got a suitability problem is because essentially you are recommending a solution that is set up for a professional client, you, to a retail client, your end investor. So you need to be really careful that you understand how that arrangement is set up and that the wording is correct and that the wording makes it suitable for your end client. Because what we need to make sure is that if you're set up as an agent-client relationship, that the DFM is running that portfolio and is running those models in line with what is suitable for a retail client, and that needs to be in writing. Because if that's not in writing, and what is in writing is that they're treating you as a professional investor, then ultimately the DFM could invest in line with what's suitable for a professional investor, which is quite different to a retail investor. So be really clear about that. Other things to think about is who reports the 10% drops. So we're all really aware of the 10% drop requirement and the reporting around it. There's been loads over the last probably 12 to 18 months that you would have had to have done. But if you're a professional investor, so coming back to that relationship, because you're a professional investor, the DFM has no obligation to report those 10% drops to you. The obligation's a little bit different. So the bit that you need to be really clear about is who's reporting that to the end client. Do you know? And if you don't know, you need to know. Other things to think about on the same theme is, as a professional client, the disclosure of things like risks and costs and charges are not the same. So you need to understand, what does that mean for your client? And actually, will the DFM still disclose risks, costs and charges as though they would if you were a retail client? Or are they going to do it in line with the professional investor rules? Because if they're going to do it in line with the professional investor rules, you need to make sure your end client doesn't miss out. They still need to get that disclosure. So it's something you really need to think about. Next, what happens if your client, so the end client, disengages with you? It's a really important question, and one that actually very few firms that I work with ever really ask, but it's really important you understand it. Because again, think about it. If you're being classed as the client under an agent as client agreement, what happens if your client disengages with you? Because they're not classed as the client. So if they decide they want to move on, which happens, we all know, clients leave. If they decide to leave you, the question you need to ask of the DFM solution is, can the end client remain invested in the solution if they're no longer a client of yours? And what are the logistics of that? Because the DFM has you set up as the client. So how does that all work? And actually, do they have to be disinvested and then reinvested in their own name if that happens? Do they have to disinvest entirely? And actually, the key thing here is, do you know? Do you know the answers to those questions? And more importantly, does your client know? Because that's a risk that they need to be made aware of. And as I say, so many firms I've worked with haven't asked that question, and you really need to. You need to understand the logistics of how that works, because there are some solutions out there where they simply say, if your client decides to leave and disengage with you, actually they can't stay a client within that solution, or they have to disinvest and reinvest. And all of those things are things that you need to be covering as part of your suitability, and you need to be making sure your client knows about. So keep that in mind. And then other things to just cover off is, does your CIP research cover the agent as client solution? And do you have rationale as to why this type of arrangement is suitable? So what I mean by that is, when you are starting off, as we talked about earlier, from a wide range of the market, and you're narrowing down all the different product providers and all the different solutions, as part of those parameters, do you have in there the way that the contract will be set up, so agents as client versus reliance on others? Can you actually can you search by that? And actually, have you noted down anywhere why you think agents as client is suitable? Really, really important one. And then lastly, does your suitability report to the client cover the agent as client recommendation and why it's suitable? So think about that. Does this go into your suitability report? If you've got an MPS solution, for example, you're recommending, and it might be set up on an agent as client basis, are you covering all of that off in your suitability report? Because you should. You absolutely should be. Okay, and then just some other notes on this before we bring it to a close. Start to think about, do your advisors understand the agent as client setup? Because if you think about it, it's got to go in the suitability report. The advisor, sorry, has to then communicate that to the client. So do they understand how it all works? And are they really comfortable talking about this with clients accurately and effectively? And then think about, do we need to tie that into T&C? Because if we're expecting your advisors to be able to talk to clients about agents as client, help clients understand what it means, then you need to be assessing them on their competence to be able to do that. So if one of your solutions within your CIP is on an agent as client basis, then within your T&C scheme for your advisors, you really need to be thinking about, how do we assess competence in this area? So think about that. Does your T&C scheme cover off whether your advisors are competent to talk about this? And then one big one, actually, which often gets missed as well, does your PI insurer know what basis your contract is on with your outsourced solution? And are they comfortable with it? Particularly, actually, if you've recently changed your CIP to include as some sort of DFM offering that's caught by agent as client, then you really need to be running it by your PI insurer, because essentially that's a change in your business model. And your PI insurer might not be comfortable with it. So just make sure, if you have recently changed, you've recently decided to use one of the MPS solutions where they do use agents as clients on a contractual basis, make sure your PI insurer is comfortable with that. And then lastly, really big one, please make sure if you are using a solution that's set up as agent as client, that your client agreement clearly sets that out, and sets out to your client that they may be invested in a solution in this way. Again, many firms I've come across don't have that in the client's agreement, and you'd need to have some wording in the client's agreement around that. So just bringing it back to why some of this is a risk to your business, there are so many points here that you've got to think about, and actually so many things where you could potentially get it wrong. And particularly going back a couple of slides, that point about whether you're being treated as a professional client or whether they're running the portfolio in line with a retail client is absolutely vital. You need to understand that, because if you get that bit wrong, that's huge. And that could be a massive impact to all of your clients who are in your CIP. Okay, so let's talk a bit then about the other side, which is reliance on others. The other way you can have a contract set up with an outsourced solution. So if you actually decide to have an agreement in place, or you find that the agreement that you have in place is reliance on others, typically this is a little more straightforward. Usually your agreement with the DFM will set out within this agreement exactly who does what. So usually we'll set that out very clearly, so we know who's responsible for what, who's going to be responsible for suitability, who's responsible for reporting 10% drops. Usually it's set out very clearly. Under this agreement, you've got a direct contractual relationship between the DFM and the end client. Therefore, the contractual agreement will typically state that the client is a retail investor, and therefore your client gets all the protections that come with that. So you don't have this issue of professional client. The contract is with the end client and they are a retail investor. Again, you have less suitability issues when it's set up on this basis as well. And that's because you don't need to do things like justify the professional investor element as you do with agent as client. So we've just talked about, haven't we, that typically you're a professional investor under agent as client, and you've got to be able to give the rationale as to why that's suitable for someone who's a retail client. But if you're set up on a reliance on others type of contract, so a tripartite agreement, you typically avoid all of that. However, you still need to factor this into your research, and you still need to evidence that you know upon what basis your DFM is going to engage with you. It's really, really important. You need to understand actually on what basis will some of these solutions engage with you, and what does that mean? What are the impacts of that? Okay, so hopefully some really good points there that you can take away and just go and check and have a little look at in terms of what you do and how you do things. I think then let's move over and just start to talk about, actually, does your CIP impact your business value? And again, from a risk perspective, let's think about what potentially your CIP, how your CIP could potentially impact that value from a risk perspective, from a financial risk perspective, actually. So I think let's start off. Does your CIP impact your business value? Question. Absolutely yes, it does. Absolutely yes. So for those of you who don't know my background, I've done quite a number of years now with acquisitions, working in acquisitions for different companies. And absolutely yes, a CIP can either make you more attractive or can make you significantly less attractive as a business. So I'll give you an example of what I mean by that. If you've got a vanilla, simple, straightforward, well-documented CIP, then you are potentially an ideal purchase. It's just exactly what you want to see. If you're going in looking at a business, thinking about acquiring them, and they've got this really nice, simple, vanilla, nothing too racy, centralized investment proposition, oh, brilliant. That's exactly what we're looking for. So think about it. If you've got a complex CIP, whether you be running in-house model portfolios with regular rebalancing, and you've got no clear documentation around that decision making, or you're using less well-known providers, or you're doing things like devising and running your own asset allocations, then your business becomes somewhat less attractive, particularly as an equity purchase. And the reason I say that is because it's difficult as a buyer to quantify the risk that you might be buying if you end up buying the equity in the business. So you'll know that if you sell your equity in your business to a potential buyer, they buy all the liability. So when you're buying all the liability, you have to understand the risk. You have to understand the risk of that. And if you go into a business who's got a complex CIP, they're doing regular rebalancing, they're running all their in-house model portfolios and asset allocations, and there's not very good documentation behind any of this, suddenly you go, oh, not quite sure this is a firm that I'm particularly interested in, because you just can't quantify the risk that sits with that advice that's being given around the CIP. So you need to be really mindful of that. And I think that brings us quite nicely then to proportionality and thinking about what's proportionate for your business, and actually what does that look like? So when I talk about proportionality, I usually am talking about what's proportionate from a CIP perspective for a small firm versus a big firm. And often, particularly when I'm just looking at wider processes in a business, I'll often say if you're a small business, maybe just 3, 4, 5 advisors, I don't know, maybe 10 to 15 staff in total in one office, you don't need to run your business the same way as maybe one of the big national IFA businesses who's got, you know, tens of offices and hundreds of staff. However, when it comes to your CIP, a little bit different when it comes to proportionality, because the level of detail, the evidence, the documentation around your CIP is exactly the same, regardless of the size of your business. You need to make sure you can evidence exactly what you've done and why, regardless of whether if you're just a one-man band or you're a big national, that evidence needs to be the same. However, something to bear in mind when it comes to proportionality is your solution, is your CIP proportionate to the size of your business? So think about, and I come across this a lot, firms, particularly for small firms who are running their own in-house model portfolios, whether that be advisory or DFM. Question to ask, is that proportionate to your business? And I see this quite a lot, actually. I see a lot of small businesses, they come to me and they ask me about getting DFM permissions because they want to run their own portfolios. And actually the question I always ask is, why? Why do you need to do that? Why do you want to do that? And is it proportionate to your business size? And when I say is it proportionate to your business size, what I mean is, are you and or the client really gaining anything tangibly better by running some of these complex in-house portfolios, either advisory or on a DFM basis? And if you think it's value add from a regulatory perspective, then you might be completely wrong. Because what you need to think about is if you're going to try and run your own in-house model portfolios, advisory or DFM, but particularly DFM, there are so many other things that come with that. There are so many other aspects that you need to consider. And actually, you need to be thinking about, have you got appropriate risk management frameworks in place to manage all the risk around that? Because when we look at things like running a portfolio, in-house model portfolios, we talk about risk-adjusted return and we look at performance of these portfolios. When we're talking about risk-adjusted return, we're talking about investment risk. But actually, the other thing you need to think about, the other element of risk that you need to think about, is actually the risk that you're responsible for. So how well did you manage the risk that sits around that CIP? And if you're a small firm and you're going to try to run model portfolios or maybe get DFM solutions, there's a shed load more risk that you need to be managing and be mindful of if you're doing that. And that comes back to this question of, is that kind of solution proportionate to a small business when you start to factor in all the operational costs that come with it? Okay, so one other things that you need to think about are you gaining any genuine economies of scale? So by running some of your own portfolios, whether that be on an advisory or a discretionary basis, you need to be thinking about, are you genuinely gaining economies of scale? And is the client gaining any significant or tangible benefit from what you're doing? So think about it. If you can prove better investment performance with your own model portfolios, one of the questions you need to ask is, can you also prove equally robust governance and risk management as maybe a larger DFM firm could? Because that's really important. We're not just talking about what better investment performance you can generate, but we're talking about actually, have you got all the necessary risk frameworks that need to sit around the outside of that to make sure your clients are protected? So ask yourself, can you also equally prove that you've got that robust governance around the outside? And then just think about the increased regulatory reporting that comes with running your own portfolios on a DFM basis in particular, all the operational requirements that come with that, and the risk management increase as well. Because we just said, particularly if you're running a DFM solution, there's so much more you've got to do around the risk management, and there are obviously increased costs that come with that. So you need to be thinking about, you've got all of these increased costs that come with running your own portfolios on a DFM basis. And of course, you've got an increased exposure to risk as well. You've got so much more that you can potentially get wrong when you're taking the responsibility for so much more of that investment process. So you've got that increased exposure to risk. So from that perspective, you need to be thinking about, is your solution that you're going to run, or you're thinking about running, proportionate to your business size? Actually, can you really gain any genuine economies of scale? And is it right for your business? Thinking about all the increased business risk you're going to be exposed to, is it right for your business? And then the last couple of points, because I think these are really, really important points, and I always ask people these questions actually. Are you experienced enough, not just qualified enough, are you experienced enough to run a discretionary portfolio? So if you're thinking of getting DFM permissions for your firm, you need to ask yourself that question. Have I got enough experience of managing investments to run discretionary portfolios? And actually, and a really good question to ask yourself, and if you can answer it, brilliant, because this is so important. What is it you think you can do better than a team of experienced, highly qualified, tightly risk managed individuals? And if you can answer that question and you can go, this is what I think I can do better, and this is why I've decided to run my own models, document it. And that's the reason why you're doing what you're doing. But actually genuinely ask yourself that question. And if you can't answer that question, you probably need to just sit and have a really good think about, is your solution proportionate to your business? Or actually, going back to the earlier point around business value, is a more vanilla, straightforward, simple, centralized investment proposition better for your business, equally as good for your clients, and something that actually is going to be more cost effective to run as well? And that's actually, it comes down to your business. What's right for your business? Only you know that. But these are all the things that you need to think about when it comes to your CIP. So on that note, thank you very much for listening. As I said, my name's Carla Langley, owner of Langley Consultancy Services. I do all of this kind of stuff. If anyone's got any follow-up questions, more than happy to take those at a later time if you want to direct them to AJ Bell. But otherwise, thank you for listening. Really appreciate it.
Thank you, Carla, for that session. It was certainly food for thought. Again, any questions you may have, let us know. So that concludes our sessions for today, and I hope you found the content useful. Before I let you go, I want to finish with a couple of minutes about AJ Bell and how we could potentially help with your CIP solutions. Looking at some key points to take away from the conversations which you've heard today. AJ Bell is a financially strong company. Looking at the advice side of the business, we have an AUA of just shy of 46 billion. We look after over 126,000 clients on behalf of 3,000 different firms, which have 9,000 different advisors working for them as well. Just to back up on that, we have an AKG rating of B+, which is the highest of an independent platform in the market space as well. Whilst we're a financially strong company, we also aim to deliver our platform and our investments at a low cost. The platform charges at 0.2 and goes through a tiering process, and our investment solutions start at 0.15 across all of the different choices available. In terms of choice, we have a range of different portfolios covering active, passive, blended, which we call pactive, responsible, and income. Again, for that, we charge 15 basis points for all of those. And we operate those across 6 different risk parameters, sorry. In terms of independent open architecture platform, you have access to the kind of complete entirety of what can be traded on there. You have access through to 4,000 different OICs, investment trusts, ETFs we have available, anything exchange traded you can access on the platform, including shares on the London Stock Exchange and any recognised stock exchange in the world as well. In terms of our models, we operate an unfettered approach. So we find it's best to use a best of breed approach, looking at all different asset managers. BlackRock, who we're on today, Vanguard are included within the portfolios, and you'll see in a range of different fund managers which are in that. And again, that is done, we see that there isn't one independent fund manager that is best for all sections. ETFs versus funds, Carla covered that off in her session. With ourselves, we have ETFs and funds in our portfolios. There are advantages and disadvantages which Carla have discussed for using those. With our platform, because we have access to the open architecture, we can run ETFs through our model portfolios, which some providers can't do, especially the passive, which is solely ETFs, which helps in keeping that cost down for clients. Finally, agent as client versus reliance on others. Our MPS on our platform operates as a reliance on others, whereas a lot of different providers operate on an AAC relationship, and that adds added protection for advisors with ourselves. Once again, just wanted to thank you for your time. Make sure to complete the feedback, which will pop up at the end, and as mentioned, we'll have your feedback in CPD across to you in the next couple of weeks. Thanks again for your time, and take care until next time.